Hello, everybody, and welcome to today's fund review. Today, we're going to look at the Vanguard Target Retirement Series. This series was selected by those of you in the Facebook group who voted on which series we were going to take a look at. We got some interesting comments and interesting feedback when we posted the poll. Some people are looking for a side-by-side comparison with maybe a couple other fund families. So I think we'll put that together as potentially a bonus video later this week or early next week. But today we're just going to focus on Vanguard target date funds, and we're going to compare them to the peer group average, not any specific target series. Before we get into that, we'll go through our disclosures. This video provides general education. Nothing shared in this video or the group is to be considered specific tax, legal, or investment advice. Don't act on any of this information without first consulting your tax, legal, or investment advisor. So when you get into target date funds, you talk about the glide path. And the glide path is the investment journey, so to speak, that it takes you on. As you're younger, let's say you're 22 years old and you're just starting in your career, you're going to be heavily weighted in equities, in stocks, the little bit more aggressive than bonds. And you're going to be that way for a couple reasons. First of all, you don't have a ton of balance in your account. You're just starting out, and you have a lot of time to let that money recover. And over the long term, all the studies and all the data shows that equities will outperform. As you get closer to retirement, you're going to be increasing your bond exposure. You're going to be getting more conservative. You have a bigger pool of money and a shorter time period to let that recover if there was a market issue. So when we look at Vanguard target date funds, if you are 40 years from retirement, the equity exposure there is about 90% compared to a peer group average. It's right in line with where you'd expect it to be, heavily weighted, almost entirely weighted in the stock market. And at retirement, Vanguard's a little bit more aggressive than the target date group as a whole. They're about 50% equity, whereas the rest of the target date funds average out to be about 43. And that's based on some of their research that shows that most people start pulling from their retirement investments at about age 72. So that's sort of in line with required minimum distribution numbers. So they're seeing that as people save for retirement, they're actually not taking it out sometimes until they're forced to do so. Whereas we sort of normalize retirement as we look at that age 65 number, they're saying we're going to actually go through retirement with our glide paths, and we're going to actually look at when people start to take their money out. So those few years stretch in there from, let's say, age 65 to 72, Vanguard's saying we still need to stay a little bit more aggressive than our peer group to try to get that return in our target date fund series. On their bond exposure side, so whatever's not invested in the stock market, they have a little bit more non-US bond exposure, and that's through their total international bond market. So almost twice what their peer group average is. Another area of the bond market that some of the research, even their own research, has shown can add value to a target date fund is the high yield bond market, or sometimes called the junk bond market. So there's no junk bonds or specific investment in the target date funds that are in the high yield category. And some of that has to do with the liquidity concerns. So because the Vanguard Target Date Fund series, like so many of their other funds, are so big and there's so many assets in those funds, it makes it tough for them to play in some of the smaller markets like the junk bond market. So they've just excluded that from their overall portfolio. The Vanguard Target Date Retirement Series is very simple in their construction, how they're put together with their underlying investments. So this is one of those weird things where you look at the number of holdings sometimes and people say, well, I only have 5 holdings. Am I really diversified? When you look at this list, for those people familiar with these funds, you know that there's well into the thousands of different investments under all of these. So even though you have 5 holdings in here, you're very well diversified. A lot of the funds that people own in IRAs are part of these target date funds, your total stock, total international stock, total bond, international bond, and then their short-term inflation portfolio is in here as well. So these are a lot of the names that you own and that you probably have. If you have Vanguard target date funds, you may have a lot of these individual funds is the rest part of your investment lineup in your 401k plan. This is an interesting conversation sometimes when we talk about active versus passive. So Vanguard would be obviously considered a primarily passive shop, although they do have some very good actively managed funds. And their target date portfolio would be considered passive, but there's still a lot of decisions that need to be made. How much goes into small and medium cap versus large cap? How the glide path is put together? Do they overweight in international bonds or underweight? So even though it's considered a passive portfolio, there's still a lot of decisions being made. And sometimes they will swap out funds or they will make an allocation change. So their last set of investment changes was back in 2013 when they added that international bond portfolio. But overall, they've made it pretty consistent that they're just going to stay at about that five different funds as part of their target date fund series. So they've had 5 funds in here for about the last decade or so. From an expense ratio, obviously, when you hear the name Vanguard, you know they're a low cost provider, and certainly no surprise here to see it. Their target date funds are among the lowest, weighing in at on average about 12 basis points, whereas the peer group average is a little over 50 basis points. So certainly no surprise here when we looked at the investment lineup that they were invested in, that they were going to be on the lower end. Performance comes from a couple areas. They've beat 75% of their peers off the recent 1, 3, 5, 10-year numbers. Some of that comes from those low costs that we just talked about. I mean, if you figure they're at 12 basis points and the rest of their peers are at over 50, they're starting the year basically with a 40 basis point head start. So all those other funds have to outperform by 40 basis points just to catch Vanguard. So they start the year with a little bit of a lead. What also has worked well is that international bond exposure, which we talked about, they're overweight earlier. So again, that's something that could come back to potentially cost them later on, but that's added some outperformance against their peers. From a firm perspective, they are growing their target date funds as many of the target date providers are, as much of the defined contributions, the employees are putting money into these target date funds. A lot of times they're the QDIA, which is the default investment. So as we move to automatic enrollment and these default funds, there's just a lot of money flowing into target date funds in general. But Vanguard made up 23% of the market in 2010, and now they're closing in on 40% of the market. Some of that has to do, especially in the last, 12 to 18 months or so, there's been a flood of fiduciary lawsuits about not being in the least expensive share class and, not doing the fiduciary duty that's required of employers to look at what target date funds they're using. So as a response to that, a lot of planned fiduciaries have just sort of rushed to Vanguard, just thinking they have a safe haven here and being part of the low cost provider, trying to get ahead of some of these fiduciary lawsuits. So we'll see if that holds up. I mean, when you put together a lineup, the cost of the target date funds and your investments overall are just one component that you look at. But I think for Vanguard being a low cost provider here, that's certainly helped them gather assets. When you look at target date funds, for the purpose of these videos, we know we have folks watching who are employees and we have some who are employers or HR decision makers. Starting first from employee perspective, you generally don't have any choice as to what target date fund family you're involved in, unless, of course, you have a self-directed brokerage account or something like that. So if you've got Vanguard funds in your lineup, you don't have the ability to invest in a different target date fund suite. Obviously, you have other funds in your lineup that you could invest in, but you don't have a lot of choice there. So what we see is some of the more advanced employees, sometimes they might do a partial allocation to a target date fund. So just because you have a target date fund doesn't mean it's an all or nothing proposition where you have to put 100% of your balance in there. Sometimes we see folks that maybe they're planning to retire at the end of June in 2022. So they're going to have half their money in a 2020 fund and half their money in a 2025 fund. We've seen that sometimes. We've seen some people who want to be a little bit more conservative than their target date fund. So maybe they are 90% invested in the appropriate target date, and then maybe they put 10% into a stable value or a guaranteed account in their 401k plan. We've seen that. we've seen some folks with maybe a longer time horizon say, we want to get a little bit more aggressive. So we're going to put maybe 80% into a Vanguard target date, and then we're going to add an additional 10 into a smaller mid-cap fund, or another 10 into international. So there are ways you can tweak if you're not entirely happy with the way the Vanguard fund's put together. But for the vast majority of people out there, if they end up in a target date fund, it's not that big a deal. They'll be just fine with that fund. And certainly Vanguard is a good home for them. From an employee perspective, we talk about cost as being a factor, but there's a lot of other factors that go into target date fund selection. And some of that is the demographics of your employees. So if you have maybe younger, maybe less sophisticated investors as part of your employee or participant pool, maybe Vanguard is a good spot for them, because we know they're low cost. We know they're fairly simple to understand. They don't have any complicated investments as part of their underlying portfolio. And their allocation is basically along with their peer group. Now, if you have somebody if you have an employer participant population that's maybe a little bit closer to retirement, then maybe you're concerned about their slight overweight to equities. So maybe that's something that concerns you. But again, demographics should play into, if you're a plan sponsor, which target date funds you select. You could potentially have a question about proprietary funds or a conflict of interest. Maybe you're on the Vanguard record keeping platform. So maybe that's a reason to use the target date funds, because maybe you can get into that institutional level share class. Or maybe you view that as a conflict of interest, where you want to be on a record keeping platform that's separate from your target date fund. So that's a consideration as well. Are you working with, do you want to put together custom target date funds, or have an advisor that's putting together your own models? Because remember, when you're in a target date fund, you're almost always in that same fund family, right? So Vanguard is only going to, in that target date fund, only going to invest in other Vanguard funds. So maybe you view that as a potential conflict of interest, and you'd rather have the advisor put together some custom models with other fund families involved. And then the other question, we always want to take a look at is, as the employer, do you want to be responsible for making these investment decisions? Are you responsible for these investment decisions now? And maybe you don't even know it. So you have, there's things you can do to protect yourself a little bit and outsource some of that fiduciary responsibility or that fiduciary liability. And are you taking those steps, or do you even know what those steps are? So all of that goes into target date fund selection. In conclusion, we know that Vanguard, they're a low-cost provider. They're obviously a strong organization that continues to gather assets, continues to gather market share. I'm going to give this fund, the Target Date Fund series, an A- overall, just because of their size. I give them sort of a bump back from an A, just because there are some investment areas where maybe their size prohibits them from really getting involved, like high yield or something like that. And I'd say, even though these score very well, you still have that opportunity to be creative with caution. If you're trying to build a portfolio around a target date fund, like we talked about before, maybe getting a little bit more conservative than your vintage, or maybe a little bit more aggressive, just do that with caution, and sort of build around that, and make sure you're looking at your overall allocation within your 401k, but also how things work on the outside as far as your IRAs and things like that are concerned. So if you're watching this on YouTube, thank you. We encourage you to join our 401k group on Facebook. If you're part of that group, you'll have the opportunity to have a say in what funds and what fund families get reviewed as part of this series. And if you're watching this on Facebook, check out our YouTube channel there, because we're going to add some additional fund reviews that won't necessarily all get posted to that Facebook group. So make sure you follow us in both locations. So I'm Brian Williams from Northshire Consulting. We can offer those 338 investment manager solutions to plan sponsors, along with participant education or one-time or ongoing plan consulting. We also do individual wealth management for individuals and families. And we can help out advisors too with looking at 338 solutions and TAMP outsourcing. Thanks very much for watching, and check out our videos coming up. Thanks.